Never working again sounds like a fantasy. It's not. Right now, there are 5 specific assets that can pay you enough every single month to make your job optional. And the whole thing starts with less money than you spend on coffee, $10 a day. That's it. In the next few minutes, I'm going to show you exactly why. Most people who try this fail, why the fund everyone tells you to buy is quietly working against you, and how one guy turned 10 bucks a day into a paycheck that shows up whether he works or not. I'm Rosa, and before we get into the how, I want to plant 2 things in your head that I'll come back to later. One is a number, and it's not your savings, it's not your age. It's something almost 8 out of 10 people heading into retirement never even check until it's too late. The other is a detail about taxes that nobody puts in these videos, and it changes how much of that monthly paycheck you actually get to keep. Hold on to both of those. We'll come back to them. Let's start with Josh. Josh has a job paying him somewhere between $1,100 and $1,200 a week, so call it $5,000 a month. That's right around what the typical full-time worker in America earns, according to the Bureau of Labor Statistics. He shows up Monday through Friday. The check lands every 2 weeks. 60 grand a year, and that number is what keeps his life running. Rent, groceries, gas, everything. One night, Josh sat down and did the math on what happens if that check just stops. No pension waiting for him, no safety net, just silence where the paycheck used to be. That's the night he decided he wanted to replace it, not shrink his lifestyle. Replace the actual paycheck. $5,000 hitting his account every single month, whether he goes to work or not. So here's the problem in one sentence. Josh needs to own a portfolio that pays him $5,000 a month in dividend income, about 60 grand a year, and he has to build it with money he can actually spare every day, not some lump sum he doesn't have sitting around. 5 grand a month, paid by his investments. That's the target. Now he has to figure out how to actually get there. And the first thing he runs into is a trap most people don't even know they're standing in. Here's the mistake almost everyone makes when they try to do what Josh is doing. They put their money into the S&P 500. They watch the account grow for 30 years. They hit retirement with $400 to $500,000, sitting there, feeling pretty good about themselves. And then they find out that account is paying them about $437 a month in dividends. That's the gap nobody warns you about. They built the wealth. They built it well. The income just isn't there. Josh dug into why. The S&P 500 was built to grow, not to pay. The yield on a fund like VU sits around 1.05%. Even if Josh somehow ended up with a full $1 million sitting in VUU, that account would only pay him roughly $875 a month. The only way to pull more out of it is to start selling shares. And the second he starts selling, the account starts shrinking. Every withdrawal makes the next one harder. One bad year in the market right when he retires, and the whole plan falls apart. And here's the number I told you to hold on to. Research on retirement withdrawals has found that something like 77% of how your retirement actually turns out gets decided by the returns you get in the first 10 years you're pulling money out, not your whole 30-year average. The first third. That's why the timing of a crash matters so much more than most people think. And it's not just a theory. The safe withdrawal rate, the number researchers use to say how much you can pull out of your portfolio each year without running out, just got recalculated for 2026, and it came down to somewhere around 3.9%. That's lower than the old 4% rule everybody grew up hearing about, which means the amount of money you need saved just to safely support the same lifestyle went up. That's not a paycheck replacement plan. That's slow account liquidation wearing a retirement label. Josh saw the trap and walked around it. He decided to build income that pays him for life And that's a completely different kind of portfolio than the one most people default into. So Josh has two paths in front of him. Path one is growth investing. He buys assets, holds them, and sells pieces later when he needs cash. The account pays him by getting smaller. Every withdrawal makes the next one harder. And if the market crashes the year he wants to retire, he's selling shares at a discount just to cover rent. Path 2 is income investing. He buys assets that pay him while he holds them. The account stays. The dividends cover the bills. The market goes up, the market goes down, and the income keeps showing up either way. Picture both paths over 5 years. Year 1, Josh puts $10,000 into a growth fund. By year 3, it's grown to $15,000. By year 5, he needs cash for a bill, so he sells shares to get it. The moment he sells, he owns less of the fund. Then the market drops 30% that same year. The fund's value falls fast, and Josh is still selling shares to pay bills, only now he's selling at a loss. Now path 2. Year 1, that same $10,000 goes into a fund, paying 5% a year. By year 3, he's collected $1,500 in dividends without selling a single share. By year 5, that's $2,500 total, and he still owns all 100 shares he started with. Then the market crashes 30% that same year. His $10,000 might be worth $7,000 on paper, but the companies inside that fund keep paying their dividends. The $500 a year keeps coming in. Nothing forces him to sell. If you've never really thought about what a dividend is, here's the short version. When you own shares of a company, you own a tiny piece of that company. When the company makes a profit, sometimes it reinvests that money back into the business, and sometimes it sends a portion of it straight to shareholders. That payment is the dividend. It usually shows up every 3 months, though some companies pay every single month. How much you get depends on how many shares you own. You own a piece of the business pays you, and no selling is required. Josh picked path 2. Dividends come from company profits, not from the share price bouncing around. So when the market drops 30%, the dividends keep showing up anyway. A paycheck replacement portfolio needs that kind of reliability, and growth investing simply can't give it to him. Now he had to go hunting for funds that actually deliver because not every dividend fund is built the same way. Josh set up 3 filters, and every fund he picked had to pass all 3. Flavor 1 is yield, the percentage of his money that comes back to him as income every year. A fund yielding 1% isn't replacing anyone's paycheck in any reasonable time frame. Filer 2 is sustainability. Today's yield means nothing if the dividend gets cut in year 7. So Josh wanted funds with long track records of paying and ideally raising their dividends through good markets and bad. Filter 3 is diversification. One company can fail. A fund holding hundreds or thousands of companies can lose a few and barely feel it. That's what makes the income reliable enough to lean on. 3 filters got him most of the way, but there was still a problem. If Josh just grabbed the 5 highest yielding funds he could find, he'd end up with 5 funds all doing the exact same job, all pulling income from the same kind of asset. One bad year in that asset class, and his whole income stream takes a hit. So instead, he split the portfolio across 5 different categories, each one earning income from a different source. That's what lets the portfolio survive whatever the market throws at it over the next 10, 20, or 30 years. Category 1 is Treasury bonds, basically lending money to the U.S. government and getting paid interest every month. The safest piece of the portfolio, Category 2, is a U.S. dividend growth fund, holding the highest quality American companies that pay and grow their dividends year after year. The growth engine, Category 3, is an international stock fund, exposure to companies outside the U.S., his insurance policy against America having a bad decade. Category 4 is a real estate fund, income from rental properties and commercial buildings without owning a single property himself. Category 5 is a high income fund designed to maximize monthly cash flow. The income engine of the whole thing. Let's go through what Josh actually put in each slot, starting with the safest piece. For Treasury bonds, he picked BND, the Vanguard Total Bond Market ETF. When Josh buys a share of BND, he's lending money to the US government, to American corporations, and to people paying off mortgages all at once, spread across more than 17,000 different bonds. A bond works differently than a stock. Owning a stock means you own a piece of a company. Owning a bond means the company or the government owes you money and pays you interest for borrowing it. That interest is what BND passes back to him every single month. BND currently yields 3.95%, and that payout has grown at about 3.64% a year over the last decade. The share price itself has actually drifted down a little, around 1.31% a year. So BND isn't a growth play. It's a paycheck play, and it's one of only two funds in this portfolio that pays monthly instead of quarterly. Bonds usually don't crash the way stocks do. Sometimes they even climb while stocks are getting hammered. That's the job Josh needed BND to do: stabilize everything so the rest of the portfolio could do its job. For the piece that grows the size of every paycheck over time, Josh picked SCHD, the Schwab US Dividend Equity ETF. SCHD doesn't look flashy on paper. The yield is average, the growth rate is strong, but not the highest out there. Josh still made it a core holding because it holds around 105 of the highest quality dividend paying companies in the country, names you'd recognize, companies that have paid and raised their dividends for at least 10 straight years running. SCHD currently yields 3.32% paid quarterly, and the dividend has grown at 10.43% a year over the last decade, while the share price has climbed at roughly 8.96% annually on top of that. So with SAHD, Josh isn't just collecting dividends, he's collecting dividends that grow, sitting on shares that are also growing. For international exposure, Josh picked IXUS, his insurance policy against America having a bad decade. It holds around 4,100 stocks from outside the US, spread across Europe, Asia, and emerging markets. IXUS currently yields 2.87%, paid quarterly, with the dividend growing at about 7.03% a year over the last decade and the share price appreciating around 6.56% annually. For real estate, Josh picked GQRE, the FlexShares Global Quality Real Estate Index Fund. Real estate is one of the most stable income streams that exists. People always need somewhere to live, businesses always need somewhere to operate, and the rent gets paid. But Josh didn't want an actual rental property with tenants and toilets and property managers. GQRE owns shares of real estate companies from around the world called REITs, Real Estate Investment Trusts. A REIT owns and operates real estate, apartments, warehouses, shopping centers, hospitals, and by law, it has to pay out most of its profits to shareholders as dividends. That's exactly what Josh wanted. GQRE currently yields 4.29%, paid quarterly, well above average for a stock fund, and that dividend has grown around 6.29% a year over the last decade. Here's the one honest catch worth knowing. REIT dividends usually get taxed as ordinary income, not at the lower rate some other dividends qualify for. It doesn't change what GQRE pays you, but it does change what you actually keep, depending on which kind of account you hold it in. The last slot is the one doing the heaviest lifting on Josh's monthly income, and it's also the fund most people misunderstand. It's JP, the JP Morgan Equity Premium Income ETF. JP owns a basket of large US stocks, similar to what you'd find in the S&P 500. But on top of just holding those stocks, the fund sells options against them every single month. And that's where most of its income actually comes from. According to JP Morgan's own fund reporting, roughly 83% of JPI's monthly income comes from those options premiums, and the rest comes from regular stock dividends. That's why JPI yields 8.46%, more than double anything else in Josh's portfolio, and why it pays every single month. Its dividend growth is much slower than the other funds, around 0.86% a year, because the yield starts out so high to begin with. Now, here's the honest part nobody mentions enough. Because JP caps its upside by selling those options. When the stock market has a really strong run, JPI's price tends to lag behind. It's not a flaw, it's the trade off built into the strategy. Income now in exchange for less of the upside later. And like GQRE, most of what GP pays out gets taxed as ordinary income too, which is worth knowing before you decide which account to hold it in. With all 5 assets picked, Josh split his $10 a day evenly, 20% into each fund, with every dividend reinvested automatically. Since each fund gets the same slice, the portfolio's overall yield is just the average of all 5. Add up 3.95, 3.32, 2.87, 4.29, and 8.46, and you get 22.89%. Divide that by 5, and the blended yield comes out to 4.58%. Using that same math, the blended dividend growth rate comes out to 5.6, 5% a year, and the blended share price appreciation lands around 2.68% a year. Here's what that's projected to look like over time. By the end of year 1, Josh has put in $3,650, just $10 a day for 365 days. Fast forward 10 years, and he's contributed $36,500 of his own money. The account is projected to be worth $53,316, paying about $2,723 a year in dividends, roughly $227 a month. Another decade in, his total contributions sit at $73,000. The account is projected at $192,839, with annual income reaching $13,643, or $1,137 every single month. Year 30 is where this gets serious. The portfolio is projected to be worth $669,187. Josh will have personally put in $109,500 of that. The other $559,687 comes from the market and from 3 decades of reinvested dividends doing their work. The income that portfolio is projected to pay in year 30 is $62,763 a year. Broken down monthly, that's $5,230 every single month without a single share ever being sold. $5,230 a month. That's the $5,000 paycheck replaced. I think about the version of Josh who sat there one night doing the math on what happens when the paycheck stops. That fear is what got this whole thing started. And 30 years later, the number on the screen isn't fear anymore. It's just Tuesday. The check shows up whether he goes to work or not. Before you go build this yourself, remember that detail about taxes I asked you to hold on to. SCHD and IXUS mostly pay what's called qualified dividends, which get taxed at a lower rate. BND, GQRE, and JIP mostly pay ordinary income, taxed at your regular rate. That doesn't mean avoid them. It just means where you hold each one matters. A lot of people keep the higher taxed pieces inside a retirement account and the lower taxed pieces in a regular brokerage account. It's a detail worth asking a tax professional about before you build this out for real. If this walked you through something you hadn't seen laid out this clearly before, that's exactly what this channel is going to keep doing. It's about building your income. It's about taking back your time. It's about building a Tuesday morning you actually look forward to. Subscribe if you want the next one. Drop a comment and tell me which one of these 5 assets you'd put your first $10 into. And if you know someone who's been putting off figuring out their retirement plan, send this to them. It might be the push they need.